Hello everyone, we are the team representing Carnegie Mellon's Tepper School of Business. Today we are going to provide an update on our portfolio for the 2014 Investment Challenge. The goal of this presentation is to help you understand our portfolio objectives and investment philosophies. We will also talk about the process on how we constructed and maintained our portfolio. Lastly, we will shed some light on what expectations we have for our portfolio and our risk management. Here is the list of our team members. We have Adam Townsend and Joseph Smith from the MBA program, and Claudia Poon, Mingguo Li, and Junting Zhu from the MSCF program. Together, we share responsibilities in providing thoughts on what we think of different factors and monitoring the portfolio. The main objectives of our portfolio is to earn risk-adjusted returns through concentrated factor tilts and exposure management, to capture absolute return by crafting strong fundamentals, and also to limit downside risk during periods of increased market volatility.
There are two main theses that are central to the investment strategy for our portfolio. The first of these is where we are in terms of the credit cycle. Since 2009, low interest rates have fueled a boom in corporate borrowing and financial leverage for many U.S. companies. At the time, due to the uncertainty associated with the U.S. economy, many CFOs chose to de-emphasize investing in organic growth and rather find alternative means to reward shareholders. This has led to increased levels of both dividends being paid as well as equity share buybacks. And while these actions have resulted in U.S. equity markets moving towards all-time highs, we believe that the credit cycle is now at a peak. This peak in the cycle should bring about an increased stress on prices for both bond and equities associated with debt-heavy companies. For our second thesis, we believe there will be a return of higher market volatility. Looking at the macro picture, we believe that there will be a number of factors that will affect how investors reassess both valuations and growth expectations for U.S. companies. First, the end of QE should bring about a normalization to the U.S. equity markets. At the same time, weakening economies elsewhere around the world will bring into question economic growth expectations for those regions. Putting all of this together, we expect that market volatility should increase as investors reassess company valuations relative towards their growth expectations.
Thanks, Joe. Let's take a look at our first factor. As Joe stated in our thesis, we feel that the current market dynamics have resulted with a peak in its credit cycle. Essentially, companies have been able to borrow money for cheap. We decided to look at this through a lens related to dividend yields. Essentially, we created a factor that would identify companies that were, 1, highly levered, and 2, paid a substantial dividend relative to their leverage. This led us to be short, high dividend-paying companies with a high debt-to-equity ratios. Our factor exposure relative to the benchmark of the Russell 1000 index can be seen in the chart at the top. And the risk contribution to our portfolio, or essentially how the factor drives portfolio performance, can be seen in the graph at the bottom. You will see that compared to benchmark, we are short in these factors, and our contribution of risk shows heavily where we are tilting our portfolio to account for that difference. In our second factor, we were looking for characteristics that we feel would hold up in a downward market. We came to the conclusion that the markets will always reward quality and growth. This led us to be long companies with a positive trajectory in price to book and price to sales values, as well as steady cash flows, return on invested capital, return on equity. Similar to the previous slide, our factor exposure relative to the benchmark in the Russell 1000 index can be seen in the chart on the top, and the risk contribution to our portfolio can be seen in the graph at the bottom. You see, with the grade three-dimensional pillar in the factor exposure chart, we are substantially exposed to profit relative to the Russell benchmark. This holds true in our contribution of risk, where profit has a stronger weight in our overall portfolio. Our final factor takes into account momentum and volatility. Aligning to our thesis, we view equities that will be volatile as movement and swings to the downside. This is most prevalent in our risk factor chart. We have the highest delta relative to our benchmark across our entire portfolio. Further, the contribution of risk is the most aggressive as well. In essence, this is our largest bet. In regards to the momentum, we do not want to reward companies that have been experiencing a steep upward trajectory in share price. However, we aren't aggressively short. This is our portfolio snapshot, aggregating and averaging the positions we have taken in the Russell 1000 index, our investment universe. You will see that this is consistent with the previous slides in regards to our long and short positions. I'm going to hand it over to Mingo, who will go into further details to how we constructed our portfolio.
Now let's talk about the selection of portfolios. We screen our stocks based on certain criteria. For long positions, we look at stocks with high return on equity, return on invested capital, and high price to sales with low volatility. On short positions, we look at stocks with return on equity inconsistent with its cash flows, high dividend yield with high debt to equity ratios, high leverage companies, high volatility, and stocks with upward trajectory. These criteria are built based on our prediction of the market trends. Once we have selected a list of stocks to fit into our long position and short position, we need to choose the number of stocks we are going to purchase for each of those stocks. So we have applied weighting methods for long position and short position. The long position is variance weighted in order to match our vision in the long volatility. Historical variance has been used. Among 75 stocks we have selected for long position, their variance ranges from 30 to 82, and therefore the range of the weighting is between 0.98% to 2.68%. We weight our short position based on its beta in order to match our vision in short beta. Beta is calculated as the historical covariance with market divided by the historical stock. In total, we have 97 stocks in short position. The beta range is between 1.14 to 2.22, and the weighting range is between 0.8% to 1.57%. On the diagram on the right, you can see the distribution of weights. Most of the stocks has an average weight of around 1% to 1.2%. We have measured our beta compared to the benchmark for different industries and for our portfolio as a whole. Our portfolio beta relative to benchmark is minus 4%. The beta relative to benchmark is within the range of minus 0.25 to 0.29 for each of these industries. On the diagram on the left, you can see the comparison of portfolio beta compared to benchmark beta for each of these industries. On the diagram on the right, you can see the relative difference of our portfolio beta compared to the benchmark beta. You can see healthcare has a relatively low relative beta, and telecommunication service has a relatively high relative beta. This is because our vision on the different factors of the market has impacted our selection of portfolios for different industries. We have also measured our exposure to different factors, and this exposure has been consistent with our expectations of the market. Besides, we have measured our relative exposure towards benchmark for each of these industries. In short, most of the industries will keep a relative exposure of less than 10%. We have a relative long view on the financials and relatively short view on the energies. Because our selection of stocks is based on the factors defined in our view on the market, and these factors has an impact on our selection of long and short of each of these industries. Once we have selected our stock and its weights, we have defined a plan to rebalance our portfolios in order to maintain our exposures to desired factors. We also keep monitoring the market and adjust our thesis if necessary according to the changing market conditions. We have a plan to regularly review our risk-adjusted performance and review the factor attributions in our portfolio. In case that the stock has experienced specific corporate actions such as defaults, merger and acquisitions, or a sharp change in price, we may choose to close unsuitable positions based on this event. On the diagram below, you can see the PL change in our stocks in the first 6 weeks since the beginning of competition. And see, most of the profit and loss in the first 6 weeks is within the range of minus $10,000 to $10,000, with some very exceptional stocks has a higher profit or loss. We also keep monitoring on the weight change for each of the stocks. More than 97% of the stocks has not changed weight significantly. It's within the range of minus 1% to 1%.
So for our portfolio, when we face a scenario when the market goes up by 10%, we should see that the portfolio has a loss of $278 or around 2.7% loss. So that indicates a negative beta in our portfolio, and this negative beta is caused by our short position in the energy sector and the consumer discretionary sector. And these two sectors are mainly relatively more volatile compared to other sectors, and this caused the negative beta of our portfolio. So as for the downtrend market, this is exactly the opposite compared with our previous analysis. On the downtrend market, we're expecting a $278,000 profit from our portfolio because of the negative beta. Another scenario that I would like to talk about is when the oil price drops. So when the oil price drops, we see a high gain in our portfolio, and mainly due to the gain in the energy sector. And that also explains our reason the profit of our portfolio in the recent month when the oil price dropped by over $20. And now we come to our risk management slide. This is a table for our 95% value at risk. So the value at risk for the total portfolio is $58,000, where the energy equities shows a very high value at risk in our portfolio, which is $34,000. So I would expect, so one of the risks in our portfolio is when the oil price goes back or the energy market booms, then the energy equities may go high, and we will see a significant loss in the portfolio. Another possibility of another source of risk will be on the negative beta when the forecast for the stock market is still positive. If the stock market still goes high for the next few months, the negative beta will also cause a loss in the portfolio as well.
In closing, we hope we've been effective in relaying our strategy, our approach, in the manner in which we execute those methodologies into our portfolio. To the extent that you have any questions, comments, or feedback, please reach out to any of the team members. We look forward to continuing our portfolio management strategies and initiatives into 2015.